All right, good evening, everybody. Welcome to Friday night. I know you've got nothing better to do than listen to me, so let's carry on. Um, After doing the class last week, I went back and looked at it again, and I think we need to do Chapter 11 in significantly more detail. So I'm going to go and do Chapter 11 again, and don't worry, anybody, because we're still on track. Chapter 11 was always supposed to be done today. I just wanted to do more ahead of time. So we're back on track now. Um, Return, risk, and capital asset pricing model. I want to take some time today to, am I muted still? Am I muted? I'm not muted. Okay, so let me try again. I think I was still muted. If I was muted, then let me start again. If I wasn't muted, then please apologize. I will apologize. After doing last week's seminar, I believe that we need to do more on Chapter 11. Specifically, I want to do more about the math on Chapter 11. I don't know what your backgrounds are in statistics. I assume you have some. But I want to make sure that you're very comfortable with it before we move on because there's a ton of math in this chapter. So let's get going. I don't think it's going to be as grueling as it has been for the last 2 weeks. So let's go, and we should be done so way before the rumored resignation of Trump this afternoon. Um, I don't know if he's going to resign or not. The rumor is at 9:45, but we'll have to wait and see. So risk return in the capital asset pricing model. We are on board land. We will return to land when we're done. Uh, we are stewarding it for the rightful owners. It will be in as good a shape or better when we finally return it. What are we going to look at? Individual securities. We're going to talk about expected return variance and covariance. Then we're going to talk about portfolios, how we make up portfolios, how we determine what the efficient state of a portfolio is. Then we start to stick more securities into the portfolio to see how we can come up with something that looks optimal. We'll talk about diversification, et cetera, et cetera. Before I start, are there any questions? All right, nothing on the chat board, no questions. All right then. So I got two quick videos to watch, and then once we go through those videos, we're gonna get into the meat and gravy here. Though I'm sorry you have to listen to the ads first.
Abilities go way beyond dashboards alone. It's about real world impact.
There we go.
How to calculate standard deviation. How many vegetables do you have in your fridge? Is that a common amount, or are you an outlier? We can use standard deviation to know whether someone's behavior is normal or extraordinary. Standard deviation, often calculated along with the mean of a data set, tells us how spread out the data is. It is used for data that is normally distributed and can be easily calculated using a graphing calculator or spreadsheet software, but it can also be calculated with a few math operations. We're going to use an example involving the number of vegetables 5 of our friends have in their fridges. They have 2, 3, 4, 7, and 9 vegetables. To calculate the standard deviation, the first step is to calculate the mean of the data set, denoted by x with a line over it, also called x bar. In this case, the mean would be 2 plus 3 plus 4 plus 7 plus 9 divided by 5, which equals 5. Our average friend has 5 vegetables in their fridge. The second step is to subtract the mean from each data point to find the differences. It's helpful to use a table like this. 2 minus 5 equals negative 3, 3 minus 5 equals negative 2, 4 minus 5 equals negative 1, 7 minus 5 equals 2, and 9 minus 5 equals 4. The third step is to square each difference. This makes all the differences positive so they don't cancel each other out. And it also magnifies larger differences and minimizes smaller differences. Negative 3 squared equals 9, negative 2 squared equals 4, negative 1 squared equals 1, 2 squared equals 4, and 4 squared equals 16. The fourth step is to calculate the mean of the squared differences. 9 plus 4 plus 1 plus 4 plus 16 divided by 5 equals 6.8. The final step is to take the square root. This counteracts the squaring we did earlier and allows the standard deviation to be expressed in the original units. The square root of 6.8 is about 2.6, and that's the standard deviation. We're done. The mean number of vegetables is 5 with a standard deviation of 2.6 veggies. Knowing that about 2/3 of the data fall within one standard deviation of the mean, assuming the data is normally distributed, we can say that about 2/3 of our friends have between 2.4 and 7.6 vegetables in their fridges. To recap, these are the 5 steps for calculating standard deviation. Calculate the mean, subtract the mean from each data point, square each difference, calculate the mean of the squared differences, and take the square root. Using symbols, the equation for calculating standard deviation looks like this. Lowercase sigma stands for standard deviation of a population. Uppercase sigma tells us to calculate the sum for each instance. X is each data point, X bar is the mean of the data points, and N is the number of data points. Keep in mind that there is a similar formula that divides by N minus 1. That formula is used when you only have data for a sample of the population. Hope this was helpful. See you next time.
All right, so that gives us a very quick look at how to calculate standard deviation from the mean. Now, taking a step backwards, before we did the square root and we had the sum of the sum of the square of the differences, that is the variation. So variation comes to the sum of the square of the differences, and then the square root of that is standard deviation. Now, how do we use them? Well, it's a good question. Oh, we get another ad first. Sorry, guys. All right.
Have we discovered a new particle in physics? Is the manufacturing process out of control? What percentage of men are taller than LeBron James? How about taller than Yao Ming? All these questions can be answered using the concept of standard deviation. For any set of data, the mean and standard deviation can be calculated. For example, 5 people may have the following amounts of money in their wallet: $21, $50, $62, $85, and $90. The mean is $61.60, and the standard deviation is $28.01. How much does the data vary from the average? Standard deviation is a measure of spread, that is, how spread out a set of data is. A low standard deviation tells us that the data is closely clustered around the mean, or average, while a high standard deviation indicates that the data is dispersed over a wider range of values. Standard deviation is used when the distribution of data is approximately normal, resembling a bell curve. Standard deviation is commonly used to understand whether a specific data point is standard and expected, or unusual and unexpected. Standard deviation is represented by the lowercase Greek letter sigma. A data point's distance from the mean can be measured by the number of standard deviations that it is above or below the mean. A data point that is beyond a certain number of standard deviations from the mean represents an outcome that is significantly above or below the average. This can be used to determine whether a result is statistically significant or part of expected variation, such as whether a bottle with an extra ounce of soda is to be expected or warrants further investigation into the production line. The 68, 95, 99.7 rule tells us that about 68% of the data fall within one standard deviation of the mean. About 95% of data fall within 2 standard deviations of the mean, and about 99.7% of data fall within 3 standard deviations of the mean. The average height of an American adult male is 5'10", with a standard deviation of 3 inches. Using the 68, 95, 99.7 rule, this means that 68% of American men are 5'10", plus or minus 3 inches. 95% of American men are 5'10", plus or minus 6 inches, and 99.7% of American men are 5'10", plus or minus 9 inches. So this means only about 0.3% of American men deviate more than 9 inches from the average, with 0.15% taller than 6'7" and 0.15% shorter than 5'1". This reasoning suggests that LeBron James is 1 in 2,500 and Yao Ming is 1 in 450 million. In particle physics, scientists have what are called 5 sigma results, results that are 5 standard deviations above or below the mean. A result that varies this much can signify a discovery, as it has only a 1 in 3.5 million chance that it is due to random fluctuation. In summary, standard deviation is a measure of spread. Along with the mean, the standard deviation allows us to determine whether this value is statistically significant or part of expected variation.
All right. I found those two videos, and I thought I'd show them because I believe it explains significantly easier than I can standard deviation and how to use it. So let's move forward from here and see if we're all in the same place. Individual stocks. Individual stock returns vary considerably. Let's be honest. I mean, we look at Nvidia that's gone up what 3,700% in the last 3-4 years. Tesla's out of control, crazy. U.S. tech stocks are going nuts, riding the AI wave, but not everybody is. And we'll look at that in a minute. But when we see returns, we expect that stocks are going to vary a lot, but we expect that within their industries, they're going to clump together a bit more. And what do I mean by that? Um, we talk about AI doing really well, and we talk about companies being dragged along with AI. My brother works for Celestica. It has nothing to do with AI. However, it's been riding the wave, and it's up about 40% this year because of that. Um, because it is in an industry that's associated, it will clump with that industry and move accordingly. So the soft drink industry has an expected return of around 9%, transportation 10, home builders 2. Um, but it makes you ask questions. Why is there such an industry difference? And if you're making investments, why wouldn't you just head to the industry that has the best return? So let's dig. If we look at the sectors, there's a number of ways we can identify the sectors, but it's calculated by so many people. I don't recommend you calculate it yourself. Just go look for it. I know this goes against what I've told you to do for the uh, project, but that's fine. So when we look on the left chart here, it's the combination of sectors that make up the S&P. So all sectors make up 100%. Technology is about 30% of the S&P. Financial services about 15%. Consumer cyclicals about 10%, et cetera, et cetera. So you can see the combinations thereof. The chart on the right says, how have we performed this month? So it looks at exactly the same sectors, but it says now, how has each one of these sectors done? And you can see that some of the sectors are doing very, very well, and some of the sectors are not doing that well at all. And yeah, we wonder, is there any cyclicality to this? Or is there any way to look at this and say, aha, there's a magic. This is where we had our moment. This is where we looked at it. So I'm going to break your heart only slightly. This shows the S&P for the last 15 years. It also shows year to date this year. In the bottom left-hand corner, it gives you the color code. But essentially what it's done is it's broken down the S&P into its components each year and told us how those components have performed. So in 2010, real estate did very, very well, up 30%. Now remember, um, remember what happens after this. And we had the financial service collapse 2009, 2010. That drove financial services down. And in fact, if we look at financial services, they're one of the bottom performing ones here. So real estate did pretty well. But if we go back to last year, real estate hardly performed well at all. So there is a lot of research that's gone into this. There is a lot of research that says if we're going into certain economic cyclicality, and if we look at the right here, by business cycle, where do we want to invest? Well, if we're early, mid, or late in the cycle and then recession, early in the cycle, you want financials. You want real estate. And if you think 2010 was really the start, 2009, early 2010 was the bottom. That was where we collapsed to, and we started to grow from there. So, financials, real estate, information technology, industrials should have done very well for the next little while. And in fact, that's what we saw, right? Um, this is not on the exam. I'm giving you background here because this is what the course is all about. How do we create portfolios that make sense? We're looking for the ability to generate returns, and if possible, to mitigate some of the risks. You cannot make money without taking on risk. You can't. I'm sorry to break your hearts. It's a fact of life. If you want a risk free investment that's going to be government bonds and they return between 3 and 5%, that's your risk free investment. If that's what you're looking for, carry on. However, if you look across the returns that we've seen, telecoms last year returned 40%. So, yeah, you're taking on risk, but instead of getting your 5% risk-free return, you're getting an extra 35% return by taking on telecoms. So what we're trying to now do is come up with a rational way of saying, fine, I get it. I get that we have to take more risk to get more returns. But how do we do that? How do we do this in an intelligent fashion that's not going to bankrupt us? So let's go. We know that individual stocks vary considerably. We know that. So what we're going to do is we're going to try to peel apart stocks and say what accounts for their movement, what accounts for how they return. So we're going to have expected returns. We're going to look at the variance and standard deviation of those returns. And then we're going to get into something beyond that called covariance and correlation. And that's, if you think about a variance and a standard deviation, we're looking about how something behaves against a mean. So we have a stock and a group of stocks, and how does this stock behave versus the group of stocks? That's variance and standard deviation. Our average stock returns 10%. Our stock in this case returned 5%. It is out returning the group of stocks as a whole. But where does it stand? And to do that, we have to figure out what the variance and standard deviation are. Then, when we start to put things together into groups and start to create a portfolio, we're now not only looking at versus the mean of the portfolio, but now it's very important to know how the stocks that we bring in interact with each other and interact with the portfolio as a whole. So we're going to get into that. And yes, there's going to be math, but it's not that, well, it can't be. Uh, I have to couch this by saying that through my school years, I didn't know because it wasn't popular at the time. I have a learning impediment, and math happens to be one of the things I struggle with. And it's a weird to have a finance professor tell you that, but um, there are ways to get around. And for me, I have to be able to see how I apply stuff to understand what the math is trying to do. So I'm going to show you what goes on in my tortured little mind here. And if it helps any of you, carry on, please. So expected return and variance. Um, what we're going to try to do now is think about what we just did, the two videos we just saw. So we need to find the expected return of the group of things that we have, or the stocks that we have. Then we have to figure out how each one of those stocks varies from that. And then we're going to go on to build variance and standard deviation and whatnot. The 8 steps we're going to follow are listed here. We're going to find the expected return, find the variance, square those deviations, sum and divide by the number of items in the return. That's going to give us our variance. We're going to take the square root of the variance, and that gives us our standard deviation. Now, if we go back to step 2 and find out what each variance from the expected return is, then we can look at each of the stocks that we add to a portfolio um, and multiply the results in each stock, and then go back and calculate the covariance and correlation within the portfolio. And I'm going to explain these as we go. So, in particular, Assume that we have two stocks. We have Supertech and Slowpoke. And I don't type exceptionally well, so I just wrote super and slow, but that's what it is. There are four states in the economy. We can have a depression, a recession, a normal economy, or a boom. Each of these stocks reacts differently to each state of the economy. So for super, we have bigger moves. And specifically, in the event of depression, we're going to go down 20%. Everything else sees us gaining ground, though. So the recession is plus 10%, normal is plus 30%, and the boom is plus 50%. Slowpoke stock moves slower and it's slightly counter-cyclical. So in depressions and recessions, we do well. 5% in depression and 20% in a recession. In normal times, however, we lose some ground and down 12%. And in a boom, we do participate in the boom, but only 9%. From there, we're going to sum these returns and divide by the number we have, and we have 4. So when we sum the returns, we just add them up and divide by 4. So the expected return in super across all 4 of the states is 17.5%. The expected return of Slowpoke across all of those states is 5.5%. Fine. Step 2. What's the deviation between the mean and our return? So we have our expected return, and how does each one of these states vary from that? So 0.175 minus 20 is minus 0.375, et cetera, et cetera. That gives us our deviation of returns. The next step is to square those deviations of returns. And we do that to get rid of the negatives so they don't cancel each other out. And then we can magnify the large and minimize the small. So once we do that and divide by 4, we end up with a variance for super of 6.6875% and a variance for slowpoke of 1.3225%. When we take the square root of those, we bring everything back to the original state up here, and we have a 0.2586 and a 0.115. What's this telling us? Well, this is where we're getting to here. I will do this in any number of ways to get people to understand where I'm going. So it's going to be repetitious for some people, and it's going to help other people. So maybe as a whole, we can all get forward here. So what have we done? We took our states here. We found our expected returns. We found the deviations by subtracting our returns from the expected returns. And then we came up with our variance and our standard deviation. What's the standard deviation tell us? The standard deviation tells us that our expected return is 17.5%, 68% of the time, plus or minus 0.2586. Why don't we go straight to variance and correlation? I guess I do. Okay. So that gives us our individual stocks. How Supertech looks, we have our deviation and our variance, and how Slowpoke looks, and we have a variation and our deviation. But how do they compare to each other? In a depression, Super loses 20% and Slowpoke gains 5%. But if we look at, where am I trying to go here? If we look at the difference between the mean and the variance in both cases, so we get to here, the difference between the mean and variance in both cases, and the expected return of 0.175 minus 0.20 gives us a minus 0.375. For slow, the expected return of 0.55 plus 0.5 gives us minus 0.5. For depression, if we multiply both those two numbers together, we're going to get what the product of the deviations is in a portfolio together. So yeah, they move. We know they move like this, but how do they move like this is what we're looking at now. Um, Once we've calculated the product of the deviations for all four states, so the product of the deviations for depression, for recession, for normal, and for boom, then we can sum those up and take, whoops, sum those up and where am I here? There, sum those up and then take the average. The average is the covariance. And that says, how does one stock move against the other? And then once we have covariance, we can take the standard deviation, we take covariance, divide it by the product of the two standard deviations. So in our case, we had a standard deviation of 0.2586 for super and 0.115 for slow. 0.2586 and 0.115, and we have our covariance of 0.4 minus. So we have a minus divided by. We end up with a correlation of 0.1639. So now we have how do they move versus each other is the covariance. And then how do they move together, which is the correlation. In our case, we have a correlation of minus 0.1639. What this is telling us is that they're not positively correlated. They're negatively correlated. Right here? Yes. Do I say it anywhere though? No, I don't. All right. So we have a small negative correlation. What that means is if slow goes up, sorry, if super goes up, we're expecting slow to go down slightly. And in fact, if super goes up 1%, we're expecting slow to go down 0.1639%. Conversely, if slow goes up, we're expecting super to go down. That's what this is telling us within a portfolio. So, why is that important? Well, it's important because if we have a portfolio of stocks that are all positively correlated, if one stock goes up, they all go up. And if one stock goes down, they all go down. We don't get any benefit at all from diversification. What we're trying to do is smooth out the highs and lows. Specifically, if we look at this chart on the right here, we talk about correlation. The first chart is positive correlation. In fact, it's perfect positive correlation. As one goes up, the other goes up. As one goes down, the other goes up. There is no slippage. The next one is negative correlation. Perfect negative correlation says if fast goes up, slow goes down by the same amount. And offsetting and offsetting and offsetting and offsetting. What you're going to get is a straight line of those two returns. And then zero correlation says, I don't care what happens to fast, it has no impact on what happens to slow. They're not correlated at all. So either perfect, no, I don't want to go there. There's something that I need to point out very, very quickly here. Particularly when we get into finance and using returns to think about what's going to happen to our portfolio, to look at correlations and stuff like that. Correlation has nothing to do with causality. Don't imply it. It has nothing to do with, just because it's correlated doesn't mean there's any implications here. X moves with Y. Because X moves doesn't mean Y is going to move. It just means they move together. Why does Y move? I don't know. Why does X move? I don't know. But if X moves, Y generally speaking moves. That's what correlation is. So don't try to imply too much into correlation because it's not there. That's not what the math is for. All right. Are we good so far? So far what we've done is we have stocks. We have two stocks. How do those stocks perform how do those stocks perform here? In all four states, this is how they perform. The expected return is the mean of all those 4 states. Then we have to figure out how each one of those states deviates from the expected return of the mean. We square that so we can get rid of any of the negatives involved and try to amplify the larges and minimize the smalls, and that gives us our variance. When we take a square root of the variance, we end up with a standard deviation. The standard deviation tells us within 68, 95, and 99.7%, 1, 2, and 3 standard deviations away from the mean, where we should expect things to fall within a normal distribution. For the bulk of assumptions in finance, we assume a normal-ish distribution. I'll say normal-ish because when we look at some things in finance, they can't go zero. They can't go below zero. For example, if we're looking at currencies, how does if the Canadian dollar against the US dollars were 76 cents, we can figure out what the standard deviation is. We know all the normals and whatnot. But I can tell you that there's no tail of that normal curve that goes negative because a currency can't go negative. So we're going to have a log normal distribution. It doesn't matter in the bulk of it until you get to the very edges, it doesn't matter. So beyond 3 standard deviations, you're going to get into tails that are going to start to get into areas that we don't want to explore. But that for the bulk of what we're looking at, it doesn't matter. So we're going to assume a normal distribution. So that says that if we have stocks that perform a certain way, that have an expected return of 17.5%, plus or minus 0.2586. So we can say 68% of the time it's going to be within this boundary. 95% of the time it's going to be within this boundary. And that gives us something a little bit more useful. Because now we can say this is what we expect to have happen. And when something else happens, alarm bells start going off. So we got to here, and then we said, fine. I know how they react to each other. Sorry, I know how they react independently to their own mean, but how do they react to each other? Do they move together or do they move apart? And specifically, covariance says, how do they move against each other? Correlation says, are they positively or negatively correlated? So if one goes up, what happens to the other one? Covariance says if the entire ship is moving, how are we moving together? So that's what I said. Right. So what does this mean for risk and portfolios? I think we can all agree that when we construct a portfolio, we're looking for the highest return possible. But it can't just be the highest return possible because we know that when we get into any sort of statistical area where we're looking for a return, we also know there's risk attached to it. So we're looking for the highest return possible within our acceptable definitions of risk. Now, I can get into definitions of risk and the parameters of it right now, but the easiest way for us to consider the risk attached to a stock or a portfolio is how does it vary from what we expect to find? So if we expect to, if we have a stock or a portfolio, say a portfolio that has a 15% expected return, what's the standard deviation of those returns? And that'll give us, 68% of the time we expect to be. I know we're looking for 15%, but the reality is that it's not always going to be 15%. 68% of the time, it's going to be 15% plus or minus 1 standard deviation. 95% of the time, it's going to be 15% plus or minus 2 standard deviations. So what we're trying to do is we're trying to create a portfolio that gives us that highest return, 15% or higher, and the lowest risk that we're willing to accept, which is our standard deviation. So we're now trying to calculate or construct a portfolio that has a very high return and a very low standard deviation. There are ways to do that. Let's explore it. In order to get there, what do we have to do? We have to look at the relationship between the return on individual securities and the expected return of the portfolio with those securities. So if I'm expecting NVIDIA stock to give me 3,700%, what am I looking at in terms of a portfolio? I mean, obviously that's going to drag my portfolio higher, but it's going to be such a tail that it's going to be way out the side of the portfolio, and it's going to be standard deviations away from what we expect to see. But we have to consider that. And then we have to think about the relationship between the standard deviation of individual securities, the correlation between those securities. So if one goes up, one goes down, and then the standard deviation of the portfolio made up of those securities. And that might not make a bunch of sense. But remember, I said if we create a portfolio of everything that's positively correlated, then we're going to have probably higher highs. But we're also definitely going to have lower lows because when we have one stock go down, they all go down. If we can create a portfolio that maximizes the return of the portfolio, but we can minimize those shocks by offsetting positive and negative correlations, then we can do some magic in the portfolio. So we have a portfolio. We have two stocks. We have Supertech and we have Slowpoke. In order to create a portfolio, we have to say, how much of each one do we want? For want of a better reason, I'm just going to say 60% super and 40% slow because, I'd rather have 60% of high performance and 40% of lower performance. How do we calculate what we're expecting to see for the portfolio? Well, we're expecting to get a return of 17.5% for super. 60% of our portfolio is going to be 17.5% return. 40% of the portfolio is going to be 5.5% return. So 60% of 17.5 plus 40% of 5.5 gives us 12.7%. The expected return of our portfolio is 12.7%, and that's calculated as 0.6 times the expected return of super plus 0.4 times the expected return of slow. Well, I changed that today. I know I did. The expected return of the portfolio is the expected return of A. Sorry, is the proportion of A in the portfolio times the expected return of A, plus the proportion of B times the expected return of B. And you can do this with as many items in the portfolio as you want. Be careful, though, because you're going to see in a minute that it gets more complicated fast the bigger the portfolio gets. The other thing you have to remember is while we're doing this calculation, all the pieces of the portfolio have to equal 1. So we have 60% of super and 40% of slow, adding them together, that equals 1. If we had 3 stocks, we do 33, 33, 33 if you want, but they still have to equal 1. And then consider what we've already come up with in our calculations. The expected return for super was 17.5, for slow was 5.5. We had the variance of each, we had the standard deviation of each. We calculated the covariance and we calculated the correlation. So the formula for the variance in a portfolio is the variance of security 1 plus the variance of security 2 plus 2 times the covariance between the securities. So what we have it here is variance of security 1, variance of security 2, and 2 times the variance of of the covariance between the two. A word about covariance. We have covariance here of minus 4.875 or 0.4875. A positive covariance increases the variance in the entire portfolio. a negative covariance decreases the variance in the entire portfolio. So how are we going to calculate this? Oh, there's correlation rare. So this is where we're at just there. I calculated the expected return of the portfolio because 40% and 60%, and we have our returns of 17 and et cetera. The variance of the portfolio now. The variance of the portfolio is going to be the variance of super here. Right here. There. Variance of super, which is the variance of super. What have we done here? G. Mm, oh, I'm sorry. I lost my mind there. So the variance of super is the variance of super times 60% squared. And that gives us 24075. The variance for slow etc., etc., etc. Right? Now, the variance for super against slow and the variance for slow against super are going to be the same. So we have 0.71, 175, 175. The variance for super against super is 0.24075, and the variance for slow against slow is 0.2116. Okay. And once again, it was to get there, we have, oh, Lord. I thought I was being cute, and I wasn't. To get there, we have 60% squared times the variance, which is 0.06 6875, and that gives us 0.24, etc. To get the variance of the portfolio, we have 0.24075 plus 0.21166 plus 2 times uh, uh, 2 times the variance between the two. And then the square root is the standard deviation of the portfolio. Easier here. That's what I've done here. Now, remember I said that it gets complicated quickly, and it does, because we've only got 2 stocks here, and we've got a matrix of 4 positions. If we had 3 stocks, we'd have a matrix of 9 positions, because we're going to have to calculate the variance of each stock against each other, and then the covariance of all the stocks. The good news is the covariance is the same across the board. But to get our variance here, what we did was we took the 0.24075 plus 2 times the covariance between them plus 0.21164 to 0.3. So that gives us our portfolio variance, and the portfolio standard deviation is the square root of that. What does this tell us? When we calculated the portfolio expected return, we got 12.7%. And that was 60% of 17.7, 17.5, and 40% of 5.5. Once we get the standard deviation of the portfolio as well, now we can say within one standard deviation, 68% of the time, our portfolio should be 12.7%, which is our expected return, plus or minus 15.44%. Or 68% of the time, we're going to be between a return of minus 2.74% and plus 28.14%. That seems wide, but we only have two stocks. So that's kind of what we're going to end up. As you get more stocks, you get a better and better and better clumping, we hope. So that's our interpretation. And once more, how do we get there? We got there by first going the long way and figuring out what all of our expected returns are. In the individual case, what the variance is for super, what the variance is for slow, what the standard deviation is for the two. Then we figured out what the covariance was by figuring out when we had our deviations from mean for each of the stocks. And then we calculated the product of those deviations for each of the cases. So we have one, oh, why don't we do it this way? We have one for depression, recession, normal, and boom. We sum them, and then we take the average of that sum, and that gives us our covariance. The covariance of each stock against each other. And then we have the correlation, which is we take that covariance and we divide it by the product of the two standard deviations. So the standard deviation for super and the standard deviation for slowpoke, and that gives us a correlation between the two. Blah, blah, blah. Okay, to get to the 0.24075, we said, what is the proportion of the portfolio that is our stock for super? It's 60%. Square that. Multiply that by the variance for super. And we're going to do exactly the same thing for slow. And that's what we come up with for slow here. When we go, the variance of slow times the standard deviation for super times the covariance for super and slow. We end up with this. Oh, Lord. We end up here. Notice that it's very close to the standard deviation of slow. All right, so now we've got our standard deviation, and now we've got our portfolio expected returns and the standard deviation. Where are we going to end up 68% of the time within this range? Fine. What does diversification do for us? Well, it's useful to go back a step. And if you think, what's the standard deviation for super? What's the standard deviation for slow? And what's the proportion of those stocks in the portfolio? If we just took a weighted average of the standard deviation, so 60% of 28.56 and 40% of 11.56, we would come up with a weighted average standard deviation of 20.12. What we actually came up with was, what did we actually come up with? Standard deviation of 15.44. Why is it 15.44 and not 20.12? Why is it lower than the weighted average of what the standard deviation should be? And the reason is because of that negative correlation. Because as one stock goes down, the other stock goes up. And this tends to mitigate this to some degree. So we end up with not a correlation which is the weighted average, but we end up with a correlation that's a weighted average affected by this negative correlation. And let me show you how in just a sec. Yeah, we'll start off with a positive correlation as much help in diversification. I already told you that. That means, yeah, in great times you can do better, but in negative times you can do way worse. So that's what we're trying to get rid of. So we get correlation to say, let's smooth this out a little bit. And um, portfolio correlation says the standard deviation of super slow is equal to the correlation times the correlation of super and slow times the standard deviation of super times the standard deviation of slow. Um, let's have a look. So we have 0.36, which is the 60% squared, times the variation, plus 2 times 0.6 times 0.4 times the this negative correlation, times the two standard deviations, plus 16, which is the 40% squared, times the variation for slow. And that gives us our 0.23851. Where do we end up with 23851? 23851, the variance of the portfolio. So, yeah, it's painful. Sorry. Now, what would happen if instead of the correlation being minus 16.39, what if the correlation was 1? What if it was perfect correlation? If it was perfect correlation, then we do exactly the same exercise, only instead of minus 0.1639, we have 1 here. And if we run those through, exactly the same formula, 0.36, which is the 60% times two, squared, times the correlation, 2 times 60% plus 40% times 1, 60% times 40% times 1, times the two standard deviations, plus 16%, 16, which is the square of 40, um, and the variance of slow, we end up with 0.040466. The square root of that is 0.2012. That is the weighted average of the standard deviations. If we had perfect correlation, the weighted average of the standard deviations would be the same. It would be the standard deviation of the portfolio. But we don't have perfect um, correlation. We're not looking for perfect correlation. What we're looking for is to have a slight negative correlation so we balance things out a bit. And what that does is when we have this slight negative correlation, we're able to drag down what our weighted average standard deviation would be to something that's more acceptable. It's still not great, but I'd rather have a standard deviation of 15.5% than 20%. And the more we can get this negative correlation to come into play, the more we can get our standard deviation of the portfolio to move away from what that weighted average standard deviation should be. So I hope that shows you how our negative correlation is going to come into play in the portfolio. So if there is perfect correlation if there is perfect correlation between two assets, then the standard deviation of the portfolio, which you calculate here at 15.44%, is going to be the weighted standard deviation of the portfolio itself, which would be 0.2012. That's not what we're looking for. We don't want that. So as long as the correlation is less than 1, the standard deviation of the two securities the standard deviation of the portfolio of two securities is less than the weighted average of the standard deviation of the individual securities. But we have to get a correlation minus less than 1. So diversification works as long as there is less than a perfect correlation between the two securities. The standard deviation of individual securities is going to be higher than the standard deviation of the index itself. Let's have a look. The standard deviation for the S&P 500 is 18.42%. from 2019 to 2023. So that's a what, 4-year period, or let's say a 5-year period. Components of that. So there's in the S&P 500, there are 500 stocks. We're just going to take a sample here. Johnson and Johnson standard deviation 17.65%, less than the portfolio. Tesla's standard deviation is 77.1, significantly higher than the portfolio. So we can put high standard deviation stocks into the portfolio, but we're going to have to offset those somehow. That's what diversification does. Now let's go back to the results we had from from here, where we have expected returns, and then we have standard deviations attached to those returns. Where are they? Here. And we're going to plot now on a chart what the expected return is on one axis and what the standard deviation is on the other axis. Because what this is going to do is it's going to let us picture what the risk-adjusted return is. And if we go down to here, this is what I'm trying to do here. Supertech gives us a return of about 17.5% with a standard deviation of 25.86. Very high return, very large standard deviation. Slowpoke gives us a return of 5.5%. It's got a standard deviation of 11.5. Very low return, very low standard deviation. The portfolio that we created of 60% Supertech and 40% slow comes in here. A return of around 12.7% and a standard deviation of 15.45%. This is exactly the chart of our portfolio and the two stocks in it. Now, we can move this dot around the graph by changing the components of Supertech and Slowpoke within it. We can never get more than 100% Supertech and 0 Slowpoke, or 100% Slowpoke and 0 Supertech, but we can have combinations within that. And what we're going to discover as we create these combinations, we're going to have a couple of them. One, if we used this line here, if there was perfect correlation between the two stocks, any combination of those stocks would have to fall on this line. It doesn't matter what combination you put together, it would fall somewhere between these 2 points on this line. Because we have some negative correlation, however, we can vary our results away from the line. For example, point number 1 here is 90% slow and 10% super. Point 3 is 90% super and 10% slow. Point 2 is a 50-50 split. Position MV is the lowest possible position on your entire portfolio of Supertech and Slowpoke. That has the lowest possible portfolio standard deviation. That's as secure or safe as you're going to make this portfolio. And you can see that it has a lower standard deviation than even the lowest of the components of the portfolio. That's what the correlation does. It allows us to move the risk left. Now, our portfolio is going to be somewhere along this line. Not much we can do about that. Any combination of our portfolio that we create using these two stocks will be on this line MV. This is our efficient frontier. That will be on the test. How do we get there? Well, the straight line is perfect correlation. There's no diversification at all. MV, this point here, is the lowest variance in standard deviation that we can find in the portfolio. The curved line, any point of this line can be reached with the right selection of securities in this portfolio. The right selection of SuperTech and Slowpoke will get us any position on this line. The curve's bending backwards, so at some point we can decrease standard deviation while we also increase return. Now, that's important. So if we went all Slowpoke, we would have 5.5% return and an 11.5% standard deviation. If we actually get to the minimum here, we're going to get a standard deviation of around 9% and a return somewhere around 7%. So we can structure a portfolio that is safer or has a lower variance than even our lowest variance stock and has a slightly higher return. This is the magic of creating portfolios. Now, a couple things. When we look at this graph in more detail, the perfect flat line has a correlation of 1. A correlation of -1 would give us a triangle. So if we had perfect negative correlation, we would deal with this triangle. Anything else puts us inside this area. A correlation of 0 where we have no correlation at all is the middle line. Then we go further out as we get negative correlation. We get flatter in as we get positive correlation. So the greatest bump comes from perfect negative correlation. Now, it's a great theoretical place. It's a great philosophical question. All stocks are positively correlated. Sorry, all stocks exhibit some signs of positive correlation. There's no way to get around it. You can't find two stocks that are perfectly negatively correlated. They don't exist. To some degree, all stocks move with the market. So in the real world, we end up with this sort of set, which was exactly this sort of set, but we look at combinations of 100% US equities and 100% foreign equities, so non-US equities. And I know this is a US, and I know we're Canadian, so, but the theory holds. As we vary that portfolio, we can create combinations of those two securities. They're going to be on this line somewhere. So 100% foreign gets us up here at around a 9.5% return and around a 17% standard deviation. US equities are about 8.5% return and about a 15% standard deviation. So we create a portfolio of 10%, 20%, 30% US equities, and we find that the minimum variance in the portfolio is about where we have 60% of the funds invested in US stocks and 40% of the funds invested in foreign stocks. That's going to give us a standard deviation somewhere around 14%. 1 full percentage point lower than 100% American, and 2.5% lower than 100% foreign. The return is somewhere between the two. This is how we explore the efficient frontier when we're creating portfolios. We have to be on this line somewhere. This is the best we're going to do. As long as we have these two stocks or these two types of portfolios. And now we get introduced to the Batwing. Now the Batwing has a problem. The line MV So this hard dark line here, if we have two securities, is the best we're ever going to do. That's here. We have two of things we can choose from. It's the best we're ever going to do. When we add more than two, we start to develop a batwing. I don't think I invented that term, so don't give me credit for it. However, it does look like a batwing. Somewhere inside this shaded area, any combination of our securities will fall. No combination of securities and no individual security in our portfolio will fall outside of this. This is our feasibility set in this case. It's not an efficiency frontier, it's a feasibility set. We know as we create our portfolio, it's going to be somewhere in here. The preferred portfolio is on this line between X and MV, because that lets us ride the leading edge of the batwing. This is the highest we're going to get in terms of returns, but not necessarily the lowest we're going to get in terms of standard deviations. Anything below this line suggests that there's an improvement we could make in the portfolio. For example, if we have the opportunity to invest in stock W or stock R, they have exactly the same standard deviation. Why would you pick the one with the lower return when you can pick the one with the higher return? Doesn't make any sense. That's what we're looking at here. If you are within the shaded area of the batwing, you will always have the opportunity to get to the leading edge by substituting something. So, but now imagine we have more securities. We looked at two already, and two gave us a matrix of 4 outcomes. 3 gives us a matrix of 9 outcomes. 100 securities is going to give us 5,000 correlations we have to calculate. I don't want to do it. I know portfolio manager paid a lot of money. I don't want to do that. Thankfully, we have modern programs that do it for us. They're not cheap, but I don't care. They can optimize portfolios, but you need to understand what's happening as it does it. You need to understand that while we're optimizing portfolios, what we're saying is, you gave me a W you wanted to invest in. I'm telling you, with the same risk parameters, you can get 2% more return by going to R. Doesn't impact anything else in the portfolio. Why would you not go from W to R? So we did that with one portfolio, with 2 stocks, and we ended up with this from 1 to 2 to 1 to 2. And you saw how painful this was to calculate. I mean, it's not disgustingly painful, but it's not easy. That's how we got to here and here and here and here, right? Now imagine doing that with more portfolios. And the problem is, if you have n portfolios, you can have a matrix that has n squared boxes in it. The good news is, one entire axis of these boxes are identical. Sigma x21, x squared 1, sigma squared 1 is going to be the same all the way across. X1, X2 cove, R1, 2 is exactly the same as X2, X1 cove, R2, 1. These ones are always going to be the same. So, where was I going with that? I don't remember where I was going with that. So the variance of the portfolio is the sum of all the terms in all the boxes. If X X2 and X3 are the percentage of the entire portfolio that are invested in the second and third asset respectively, then the covariance of the second and third axes are going to tell you how it reacts to each other. Specifically, if the portfolio is $1,000 and the second asset's $100, X2 is 10%. Now we're getting somewhere. Covariance R2, R3 is the covariance between second and third assets accordingly. Here. Here. So it is X2 slow, sigma slow. Now the diagonals are all going to look the same as I said. Well, I don't know where that's supposed to go. Up here, I think. So if we have one stock in the portfolio, we have one term, we have one number in the diagonal, we have a number of covariances is 0 because we only have one stock, right? We have two stocks. We're going to have 4 stocks in the matrix. We're going to have 2 variances calculated because we only have 2 stocks. And we're going to have 2 covariances calculated. If we have 3 stocks, we have 9 stocks in the matrix. We're going to have 3 variance terms that we come up with. And we're going to have 6 covariance terms that we come up with, et cetera, et cetera, et cetera. So you can see as the portfolio gets large, the math becomes very painful. The variance of and return of portfolio of many securities is more dependent on the covariance between the securities than the variance of the individual securities. And that's what it tells us here. The covariance between the securities and the variance of the individual securities. We're looking at 2 times the covariance and 1 time the individual variances. So that gives us our clue here. The variance in the portfolio has more to do with the covariances than the individual variances because we're using 2 times the covariances, right? All right. Diversification. Now we've looked at theoretically how diversification works. We looked at using negative correlation to drop the standard deviation from a weighted average standard deviation to a portfolio standard deviation. We looked at how risk and returns in individual stocks could impact the risk and return on the portfolio. We looked at the creation of an efficient frontier by moving the combination of stocks around to say, how do we stay on this efficient frontier by just combining different stocks? And then when we looked at many stocks, we discovered there's a bat wing. We still want to get to the efficient frontier, but we recognize that within this, there are going to be stocks that we pick where we can find a better stock that's going to be right on the efficient frontier. So the choice between W and R, the choice is not between risk profiles because they have the same risk profile. The question is, as long as I can say give you the same standard deviation, would you rather have an 8% return or a 10% return? And most people would say I'd rather have the 10% return. So that's where we got to. We touched on diversification as the reason for why we create portfolios. Because what we're trying to do is we're trying to say, I want all the benefits of having great moves in my portfolio. But what I'm trying to do is I'm trying to limit the downsides. To limit the downsides, I have to give up some of the upsides. There's nothing for free, but that's fine. As long as I can create a portfolio that gives me a return that's acceptable with a risk profile that's also acceptable, then I can accomplish that using diversification. So consider the Dow Jones Industrial Average. There's 30 stocks. And frankly, if you're watching averages and indexes, don't watch the Dow Jones. Too many people do, and that too many people view that as a symbol of where the market is. The market is. It's not. It's industrial stocks. The world's not an industrial world anymore. It's not a good uh, synopsis. It's not a good synthesis. It's not a good proxy for the economy as a whole. So don't use it. The S&P 500 is a significantly better index, but we're using it anyway. So the Dow has 30 stocks. In 2023, it rose 14%. Within that, three stocks, Salesforce, Intel, and Microsoft, had gains between 57 and 98%. Within that, three stocks, Walgreens, Chevron, and J&J, had losses between 11% and 30%. The 30 stocks together generated a 14% return. So some went up and some went down. Now, when we look at why diversification works, we have to think about what a stock is and what a value of a stock is. And early on, we talked about bonds and stocks really just being the net present value of the cash flows that you're expecting to receive. And that's a gross simplification, but that's essentially what it is, right? Um, so uh, I'm expecting to get earnings of X from a stock. I'm willing to pay a multiple of X for that stock for a number of reasons. What I'm going to end up getting is a combination of expected things and unexpected things. The expected things are called normal. This is what we think is going to happen. I'm not surprised because I expected it to happen. The unexpected things called risk because I didn't expect those to happen. And think about it. The combination of those two gives us our result. What we're trying to do, we're trying to figure out ways to mitigate this unexpected piece, the risk. It's called hedging. We're trying to get rid of that. Now think about what is unexpected. News and research, government releases, inflation, GDP, unemployment. We see them coming out every week, every month. Well, not right now in the US because they're shut. But apart from that, in normal places, they come out on a monthly basis. What happens to your rival? If you're Ford and Tesla blows up, what happens to you? Is there an impact? There might be. Your sales are higher than expected. Your competitors' sales are higher than expected. Or there's a sudden drop in interest rates and all of a sudden your funding becomes cheaper. Or you're selling cars and there's a sudden drop in interest rates and the payments become cheaper. What if there's key person news? What if the president of the company dies? So the return is going to be your expected return plus an unexpected component. What's the unexpected component? I don't know because it's unexpected. But let's talk about it for a minute. So the unanticipated part of the return is the true risk in the investment. The stuff that we don't expect to happen. Because if we didn't expect it to happen, it wouldn't be expected, right? So some of the impacts are unique to the firm. Some are more general to the economy as a whole. If something unexpected happens that affects everybody, to a different degree maybe, this is systemic or systematic risk. Economics, COVID-19, wars. It impacts everybody. Not to the same degree, but it's going to impact everybody. And then there's unsystematic risk, and that's your risk. One asset, one company, one group of assets, one group of companies. A small oil strike by a single company. Unsystematic risk is also known as idiosyncratic risk. Now, that means we can break up the formula we have here. says risk is expected risk plus unexpected risk. And now we can say the unexpected risk is a combination of market risk and idiosyncratic risk. It's a combination of systematic risk and unsystematic risk. Some of it's going to impact everybody, some is just going to impact you. What happens is when we diversify, we can get rid of some of the risk in the portfolio. Specifically, we can yeah. Let me get my brain together here. Sorry. My brain works worse on a Friday than it does any other day, but it doesn't work great at the best of times. If you think about the idiosyncratic risk in your portfolio, everybody's is different. Every stock in your portfolio has a different idiosyncratic risk. Some are going to be positive, some are going to be negative. So that's what we're looking at here. Some of it we can diversify away. Some of it we can't. Some of it's just going to be there. The unsystematic risk of a portfolio is going to be lower than the unsystematic risk of individual stocks. Exactly the same, for exactly the same reason of correlation. Some are going to be up, some are going to be down. Correlation says, as a whole, the combination is going to be lower than the summation of them. Every time we add another stock to the portfolio, it drops the systematic risk in the portfolio. Unsystematic risk in the portfolio, sorry. Unsystematic risk we can't get rid of. The risk that's specific to your stock that we don't know about, you can't hedge because you don't know about it. It's a logic loop, but there we are. That's the undiversifiable risk. There's nothing you can do. There's no combination of elements that I can put together that is going to get rid of the idiosyncratic risk in stock. So we have to accept that. And then we have to figure something out about that. So what happens to diversification? I want to think about this. So we did I didn't do the study. A study was done. It randomly selected New York Stock Exchange securities, and there's thousands of them. That's not just Dow Jones Industrial Average. That's all the securities on the New York Stock Exchange. They created thousands of portfolios, and that said, how do these portfolios perform? We can back test them. So we created portfolios of one stock, 2, 4, 6, 8, 10, all the way down. We looked at the standard deviation of each of those portfolios. A portfolio with one stock had a standard deviation of about 50%. Two stocks dropped to 37%, 30%, 27%. As you keep adding stocks, it keeps dropping. But once you get past 100 stocks, you start to lose a lot of that benefit. And in fact, the ratio of portfolio standard deviation to the standard deviation of single stocks never really gets better after about 100 stocks. So you lose a lot of the benefit after about 100 stocks. Now, that's the good news. Well, that's the good or bad news. I'm not sure which. What that means is a portfolio manager, you don't have to have a portfolio that's a billion stocks. Anything more than 100 stocks, you're creating problems. So some of the riskiness of individual securities can be eliminated by forming portfolios. We know that. The benefit drops off as you add more securities. We know that. We also know that there's a minimum level of risk that you're never going to get rid of. And we see that from the standard deviations over here and the standard deviations in the portfolio. We never get much below about 19.5 or 20%. That seems to be, if you want, the latent risk. That seems to be the idiosyncratic risk that is buried in the portfolio. You never get rid of it. We do, however, have a new word for that now. Is it time now? Well, I'll give you the name anyway. It's called beta. We're going to come back to it in a minute. This is not it's the non-diversifiable risk. It's the piece that it doesn't matter what we do is going to be there from each individual latent stock. So let's think now. If we can create portfolios of different stocks, which are by definition risky assets, what happens if we start to combine risk-free assets or riskless assets into our portfolio? Now, I want to be careful with the term risk-free because I violently disagree with the term. But we're assuming that government risk is essentially risk-free. There's no default risk attached to it in a Western country right now. I can't hedge that anymore. So, what happens if we now create a portfolio of risky and riskless? What happens? So, let's think about a stock called Merval and a riskless asset called bonds. Merval has a return of 14%. Do I have this in the spreadsheet? Merval has a return of 14%. The bond has a return of 10%. What makes the bond riskless? Zero standard deviation. Merval gives us 14% with a 20% standard deviation. The expected return is the weighted average of the expected returns. We have, what did I say? Did I say 35, 65? What did I say? 35% Melville, 65% riskless. Okay. So our expected return is going to be 35% of 14% and 65% of 10%, which gives us 11.14. The variance in the portfolio is going to be the 0.35 squared. Have I calculated the sigma yet? I haven't calculated the sigma yet. It doesn't matter how I do this, does it? Yeah, so we have a standard deviation of 20%. Since the risk-free asset has no variability, so it has variability to 0, anything we multiply by that is also 0. So we don't have to worry too much about the cross correlations or the cross covariance and stuff. What we have to worry about is Merval. So 35% of our investment has a 20% standard deviation. 35% squared times 20% squared gives us a revised variability of 0.0049 or a revised standard deviation of 7%. So our portfolio standard deviation created by 35% Merval and 65% riskless assets is going to have an expected return of 11.4%. That's 35% of this and 65% of that. Since this has 0 standard deviation, it gets rid of half of our equation. So all we're really concerned about is the 35% of Merval. Merval has a standard deviation of 20%. That means the variance is 20% squared. 35% squared times 20% squared gives us 0.0049. The square root of that is our, yeah, so that's our revised variability. The revised standard deviation is 35% of 20%, or 7%. So what have we done now? We've created this strange portfolio. We've created a strange portfolio that has a risky asset and a riskless asset. We're getting a straight line out of this portfolio, not a bat wing, because one of them has 0 standard deviation. So 35%, 65% gives us a return of 11.4% and a standard deviation of 7. So a return of 11.4%, a standard deviation of 7. Merville Enterprise themselves gives us a 14% and a standard deviation of 20%. If we had borrowed that 10% instead, if we borrowed, say, 20% and then invested that in Merville, we'd now have 120% invested in Merville. And all that does is extend the line. So our 35-65 line, our 100% Merville line, extend that out to infinity. That's the only line you're ever going to get to. Borrowing is only going to extend the line further. But guess what it does? It increases the standard deviation too. So if we borrow $200 risk-free to add to our $1,000 investment, we're investing 120% in Merville now, and 20% in minus 20% risk-free. So what we end up with is 120 times 14. That's the return, 14%. Minus 2 times 10. Added together gives us a return of 14.8. 14.8 is higher than either 14 or 11.4. So we are doing better. However, we're just extending the line further because our standard deviation now is 120% of 20% or 24%. Borrowing anything increases the variability of the investment. Even if it's risk-free, it's going to increase the variability of the investment. So let's look at optimal portfolios then. We're going to combine a bunch of things here. We've got our Batwing. We've got the line that we just made with risk-free and non-risk-free assets. And we're going to have a new line up here, but we're going to get to that in a minute. We have 3 stocks, AT&T, General Motors, and IBM. And we have a risk-free asset called risk-free. Point Q says we're investing 30 to, point Q says we invest exactly that proportion in the portfolio. AT&T's $30. We're investing $30. We're investing 45. We're investing 25. If we now say we're going to invest $70 risk-free of our $100 investment, we now have $30 left to invest in the same proportion. So now we have $70 risk-free, $7.50 IBM, $13.50 GBM. How am I here? Yeah, here. So what I've done is I've said, if we're taking 100 and putting 70 here, then 100 less 70 is 30. So we have 30 allocated exactly the same proportion. That's when we lend 70. If we borrow, now instead of having $100 to invest, we now have $140 to invest at exactly the same proportions. So we have these 3 portfolios where we end up. These 3 portfolios. How do those look on a line? We have point 1, which was to the left because we lent. We have 3, which is to the right because we borrowed. And we have Q, which was our portfolio. So that's the one line. And we can only ever extend this line. It's only ever going to be straight. We have our ideal mix here. If we invest some, we're going to lower the standard deviation, but we're also going to lower the return because we're investing risk-free. If we borrow, We increase the return slightly, but we also increase the standard deviation by the percentage of whatever we borrowed. The optimal portfolio is going to be the XY line. To get there, where are we here? 70% riskless is here. 0.3 is borrowing. And then for the optimal line, the risk-free line is redrawn to touch point A. Point A is the efficient frontier of our portfolio where we want to get to. And this is the only point where our capital markets line, line 2, which we just created, touches our efficient frontier. So it touches the riskless point as well as the efficient frontier at point A. Line 2 is the combination riskless portfolios. We can borrow to invest more of a portfolio in A, and then anything on line 1 can be matched by anything on line 2 by borrowing a riskless security and investing in the higher return security. So much like, whoops, where were we here? Much like here, where I said, if you have a choice between W and R, where they both have the same standard deviation or the same risk profile, do you want one with a lower return and one with a higher return? You want one with a higher return. So when we're creating portfolios using risk-free assets, we have the same sort of choice. Do you want to be in Q, or do you want to invest in other assets with the same risk-free portfolio that gets us closer to this optimal line? That's what we're trying to get to. The only way to move along line 2 and along line 1 is to accept more risk. The only way to get higher is to get riskier. So regardless of the risk tolerance, you would never accept any other point on the efficient set of risky assets XAY. XAY. It doesn't matter what your risk tolerance is. You should not accept any other point, because if you accepted a point in here, you could always get a better point up to the line by accepting a different stock that has exactly the same risk profile. So the risk-free point is here. Point A is here, and the line extends. If we combine point A on this portfolio with riskless assets by either investing them or borrowing them, we can only move up and down this line. The proportion is determined by your risk preference. You will be told through a number of ways what is an acceptable risk profile. Given that risk profile, there's only a certain number of things you can create. There's only a certain number of stocks you can put together in your acceptable pile that gets you up to this line. All right. Did I actually touch on? I haven't yet. Okay. The market equilibrium portfolio. Why doesn't everybody have the optimal portfolio? We know where it is. We've defined it. It's this XAY line. We know that the only place we can exist is inside the bat wing, and the optimal place is on the leading edge of the bat wing. So why doesn't everybody have the same portfolio as the leading edge of the bat wing? Why? If everybody has, and financial economists will tell you this, in a real world, all investors possess all the information. We have the same expected returns. We have the same variances and covariances. We have all the same news. Why, in that world called homogeneous expectations, everybody has the same expectations, why don't we create the same portfolios? If it were true, all investors would have exactly the same portfolio at point A. The problem is they don't, because everybody has a different risk aversion. Your risk aversion is going to determine where you move up and down this line. If you don't have access to risk-free assets, you can only have the Batwing. Now, within the Batwing, we have our optimal efficient set. That's where everybody's going to go. Where on this efficient set is determined by your risk profile. How much standard deviation are you willing to accept? Because if you're willing to accept this much standard deviation right here, that's the best place you can be. Not everybody has the same risk profile, because some people are hunting for more returns. In a world where with homogeneous expectations, all expected everybody would hold the same portfolio. We don't have the same portfolio. However, we can talk about that portfolio called the market portfolio. That's the ultimate portfolio. With a balanced set of expectations, this is what the market should put together as a portfolio. Now, a broad-based index is a good proxy for this. The S&P is a good proxy for this. So rather than saying, I want to create this market portfolio, why would you? It's already created for you. However, let's talk about risk inside this market portfolio. Remember, each stock is comprised of systematic risk and unsystematic risk. Some of the unsystematic risk can be hedged away in a large portfolio. That means that when we're trying to concern ourselves with risk, we're really concerned about the systematic risk. What moves everything at the same time? That's called beta. The systemic risk of a security is called beta. Okay, so think. We have two types of markets. We have a bull market and a bear market. We have a stock called Jelco. If we have a bull market and the market returns 15%, we're going to have a 25% return. In a stage 2 market, the bull market returns 15%, but we only have a 15% return. State 3 and 4, state 3 bear market drops 5%, we drop 5%. 4 bear market drops 5%, we drop 15%. Now, in each one of these markets, there's only 2 available alternatives. In the bull market only goes up 15%. Half the time we go up 25, half the time we go up 15. That means that the expected outcome is 20%. If the market falls 5%, we either fall 5 or 10 or 15%. So the expected outcome is minus 1%. What's the difference between bull and bear? 20%. 15% minus 5% is 20%. 20% minus 10% is 30%. The responsiveness coefficient, which were just discovered and invented, is 1.5. What's that mean? If the market returns 20%, we return 30%. We are going to move 1.5 times wherever the market moves. Goes up, we move 1.5 times when it goes up. Goes down, we move 1.5 times when it goes down. That's our responsiveness coefficient. In a bull market, we expect to outperform by 50%. In a bear market, we expect to underperform by 50%. And that gives us this line. we can create the line using all these four components, but it doesn't matter. This is where we end up with. -5, -10, 15, and 20. Okay, and then we get the slope of this line is the beta is 1.5 times. The systematic risk in this security Jelco, the beta of the security Jelco is 1.5 times. What that means, returns of Jelco will magnify returns in the market, plus or minus, by 1.5 times. How does this look? When we hold this magical market portfolio, and we have stocks inside the portfolio, some stocks are going to move more than others. For example, selection of stocks inside the S&P 500. The estimates of beta for these stocks, remember, this is the beta here, the slope of this line. For Con Ed is 37. For Disney's 138. What this is telling me, for a dollar move in the market, Con Ed is going to move 37 cents. Disney's going to move $1.38. More correctly, for a 1% move in the market, Con Ed is going to move 0.37%, and Disney's going to move 1.38%. So beta measures the responsiveness of a security to movements inside the market portfolio. The covariance of the asset I and the return of the market portfolio over the variance of the market portfolio. I'm not sure what I meant by that. The beta of all securities when weighted by the security proportion of the market portfolio. Oh, now I understand what I meant by that. If a portfolio is worth $100 and Consolidated Edison is $37 of that portfolio, then the beta of that the beta is going to be 1. All of the betas in the portfolio are going to equal 1. All right. We're almost there, guys. We're almost there. As I said at the start, when we invest in anything, we recognize that we generate a return by taking on risk. What we've done now is said, what is the expected return we get on this stock? And what is the expected risk attached to that? What's the standard deviation? If we expect a return of 14%, how much would we like to see that vary? The more we see that vary, the higher we expect that return to be. So, the expected return on the market is the risk-free rate plus a risk premium. And everything will trade that way. When you look at any combination of portfolios, any combination of returns, you're going to see a number of lines on any chart that anybody's looking at. And one of those lines is going to be, where's the government line? Where's risk-free? And then I want to see, where's my stock versus that? Or where's my bond versus that, or what? So what we have is we have the risk-free rate. Let's assume it's 3%. We have an excess return of 7%. So our expected market return is 10%. Now, there's been a ton of work on this. Where has the risk premium been? And do I dig deeper into this? I don't remember if I do or not. I don't think I do. What they did is they looked at the performance of U.S. common stocks from 1900 to 2010, so 110 years. They looked at what the standard deviation was for the markets and what the standard deviation was for individual stocks, and then did a bunch of magic in the back. The risk-free rate for stocks in that 110 years is about 7%. It's 7.2%. So we're going to assume it's about 7%. For 110 years, without taking any extra risk, you should have generated about 7% a year. Now, the expected return of a security and the beta of the security, so the piece of the security you can't hedge away, the systematic risk in the security is a good relationship. It's linear. We expect that the return of an asset should be positively correlated to the beta of that asset. And they are. The expected return is the risk-free rate plus the beta times the difference between the expected return on the market and risk-free rate. Or the expected return is the risk-free rate plus the beta times the expected return minus the risk-free rate. The risk-free rate is the intercept of this line. Sorry, risk-free rate is this intersect here. The slope of the line is the expected return minus the risk-free rate. For example, Aardvark has a beta of 1.5. Zebra has a beta, zebra, I don't care how you pronounce it, has a beta of 0.7. The risk-free rate is 3. The difference between the market and the risk-free rate is 8. So we have a risk-free rate plus 1.5 times the beta of the difference between the market and the risk-free rate is 0.15. The risk-free rate times the beta plus the beta times the risk-free rate of 8% is 0.86. That gives us the two examples of the difference between market and risk-free rates. Last point. The relationship is expected to be a straight line. It holds. If we do anything else, it becomes a nightmare. So it holds. It holds for portfolios as well as securities, by the way. The beta in the security and the beta in the individual portfolios should be able to be calculated exactly the same way. The return of a portfolio is the weighted average of the returns of each asset added together. And this just complicates, so I'm not going to do that. That's all I've got for this evening. Quick 2-hour lesson. I hope that clarified up chapter 11. Reminder, you got to get that homework into me. Not everybody has so far. You've got till midnight. If anybody needs an extension, talk to me. I will give you one, but I'm not going to give it to you for free. So it's going to cost you 5% a day. If anybody needs anything, please let me know. I'm relatively sure that this has been recording this entire time now, so I will have this on as soon as I can. And I don't know what happened to the recording last week. I really apologize for that, guys. I spoke my heart out, but it didn't record. So now I've made up for it. If there's any questions, please reach out to me. Otherwise, have a great weekend, guys. Enjoy the fact that the snow went away for a brief period of time and carry on. Thank you very much. Have a good evening.
Thank you, sir.
Thank you.